Many people are afraid that the recent large increase in the money supply will lead to high rates of inflation. They believe this because in the past, large increases in the money supply did lead to high rates of inflation. And they believe this because that's what the economic textbooks still teach. If they're right, and inflation does move significantly higher, then interest rates will move much higher too. And if interest rates move up sharply, that would be very likely to cause a painful plunge in the price of stocks, property, and even gold. These fears are misplaced, however. Large increases in the money supply no longer cause high rates of inflation. There are two reasons for this. First, money is no longer what it used to be. And second, our economy is no longer what it used to be. This video will begin by explaining why large increases in the money supply used to cause high rates of inflation. It will then discuss the three major developments that, over time, severed the link between money supply growth and the inflation rate. MacroWatch has touched on this subject before in earlier videos, but those videos focused only on one measure of the money supply, base money. Recently, many economists have been warning that even though very large increases in base money haven't caused high rates of inflation during recent decades, that this time is different, and there will be a surge in inflation, because this time, not only has there been a large increase in base money, but there's also been a large increase in M2, a different measure of the money supply. So this video will also show that a large increase in M2 doesn't cause high rates of inflation anymore either. Let me be clear, this presentation is not arguing that the rate of inflation in the United States will not rise. In fact, inflation is quite likely to pick up over the months ahead, although the increase is unlikely to be very large or sustained for very long.